My goal in writing this video was very straightforward. The world of finance, particularly the stock market part, is intimidating to many people, yet investment decisions obviously play a huge role in determining future security and the ability to provide for a loved one. Since the stock market is such an important component in everyone's portfolios, I wanted to make a simple enough video so that everyone can understand, even my non-existing kids. And I promise one thing in this video, I will make everything as understandable, clear and simple as possible. I won't tell you anything and I won't talk about a sponsored broker. Hi, Jared here, and today let's talk about the stock market. First, we will see how the stock market works, then why choosing the stock market over any other investments such as cryptocurrency or anything else, then the two most important rules to know, and finally, how to apply everything in real life. First, how does the stock market work? And let's dive into it. More people own stock today than at any time in the past. Stock markets around the world have grown as more people embrace the benefits of capitalism to increase their wealth. Yet, how many people have taken the time to understand what investing is all about? My suspicion is not many. And why exactly does the stock market go up? Or sometimes goes down, or sometimes does nothing. In fact, it is highly simple. The market is based on people buying, selling or holding their stocks. They can buy Apple because they think it's a great company, because they like their products or services, or because they just think the price will go up or down, or does nothing again. And they can sell because they think Apple is no longer a profitable company, or they might need their invested money to buy a new house, renovate their garden, or whatever. We don't care. In fact, the market is irrational. People buy or sell based on emotional decisions. So, the goal is to make that decision as rational as possible, using real data and not just our fingers to sell Apple just because it sold less iPhone this year. That is kinda stupid, I think. I use value investing. It is based on the intrinsic value of a company, meaning its real value. The value investing principles have consistently produced market-beating returns over prolonged periods of time, according to a pile of evidence and data. And doing it is simple. According to some estimates, barely 5 to 10% of professional money managers follow such rules. Okay then, why choosing the stock market over any other investments? And the answer is again, very simple, because it always produced fairly good returns over a prolonged period of time. So if you want to do as little work as possible and you don't mind doing average, an index fund could be a good choice. But if you are capable of analyzing businesses and willing to do a fair amount of work, then selectively picking individual stocks can be a viable alternative. For instance, you could think about the S&P 500 stock index, which is like a basket of the 500 biggest US companies. And you will observe that over long periods, its earnings have grown an average of about 6% per year. Typically, 3% of the increase has come from the growth of gross national product, and 3% has come from inflation. Therefore, the intrinsic value of the S&P 500 increases about 6% a year. In addition, the S&P 500 pays a dividend. Historically, the dividend yield of the S&P 500 has been in the range of 3% to 4%. Then, take the sum of the long-term earnings growth, so 6%, and the dividend yield, so 4%. And you get a long-term annually compounded rate of return for the S&P 500 of about 10%. This is the return investors in an index fund expect to make over the long term, and if they stay in the index fund long enough, they should get that return. It also means that if anyone asks you to loan them money or to invest with them over the long term, they better expect to pay you more than 10% a year. Why? Because you get 10% a year without taking any risks. All you have to do is investing monthly a few $100s into an ETF mirroring the S&P 500 to get that 10% each every year. Okay then, but what if you want to make even more money in the stock market with technically taking risks? Well, this is where value investing comes into play. The beauty of value investing is its logical simplicity. It is based on two principles. First, what is it worth? So intrinsic value, And secondly, do not lose money, so margin of safety. These concepts were introduced by Benjamin Graham in 1944, and they are still relevant today. First principle, buy on sale. On sale are two of the most compelling words in advertising. Imagine that you are in the supermarkets, strolling down the aisles gathering your groceries for the week ahead. In the mid-aisle, you discover that one of your favorite steak is on sale, down to just $2.50 per pound from the usual $8.99 per pound. Then, what do? You load up the cart while it's cheaply priced. When you return the next week and see those delicious steaks priced at $12.99 a pound, you pause. Perhaps this week chicken or pork might be a smart buy, and this is how most people shop. They wait until they see that refrigerator or dishwasher on sale, no matter how much they want or need a new one. Most people tend to look at pretty much everything they buy with an eye on the value they get for the price they pay. When prices drop, they buy more on the things they need and they want, except in the stock markets. Who knows why? Okay, now that we have understood the first principle, which is buy on sale stock, we have to easily understand value investing. Let's say that our new entrepreneur from Silicon Valley, named Tim Cook, built one store selling apples. He started selling apples in high school. He made his family and friends investing in the project and has now multiple stores across the town. 3 years later, he now wants a hefty $6 million for half ownership of his business. Of course, $6 million is more than most of us can afford, but luckily, Tim isn't looking. Of course, $6 million is way more than most of us can afford, but luckily, Tim isn't looking to sell half ownership of his business all to one person. In fact, Tim has decided to divide ownership of his business into 1 million equal pieces, or shares as they are referred to on Wall Street. Tim's plan is to keep 500,000 shares for himself and sell his other 500,000 shares for $12 a piece, or $6 million in total. So anyone interested in buying part of Tim's business at that price can buy one share for $12, 100 shares for $1,200, or 1,000 shares for $12,000, or pretty much any number of shares they want. And it's not over. If you were to buy, for example, 10,000 shares costing $120,000, you would then own 1% of Tim's Apple shops. And that is highly important. That 1% does not mean that you would own the Apple department on one piece of the stores. No, your 10,000 shares or 1% ownership of Tim's Apple shops mean that you would be entitled to 1% of the future earnings of the entire Tim Apple's shop business. Well, that looks pretty fun and good, right? But what matters here is what we think it's worth. So let's take a look at some of the other information Tim has given us. It seems that last year, Tim sold a total of $10 million worth of apples from the 10 stores in the highly successful Tim's Apple shop chain. Of course, the $10 million is how much apples Tim stores sold, but unfortunately, $10 million isn't how much profit Tim made. Obviously, Tim's stores wound up a few expenses along the way. Naturally, there was the cost of the apple that Tim sold that totaled, let's say, $6 million. That left him with $4 million in profits. But wait, we're far from finished. There was the rent Tim had to pay for the use of his 10 stores location. Then there were those pesky employees who for some reason expected to get paid for selling apples and keeping the store clean and running smooth. There were electricity and heating costs, trashing removal and accounting and all kinds of administrative costs. So Tim could keep track of all the money and apples flying all over the place. And in this case, another $2 million in expenses, to be exact. Which is true, that got Tim's business that to $2 million in profits, which is pretty good, right? But as you would expect, we are not done yet, because Tim had to pay taxes. The government needs money to provide services to its citizens, and profitable businesses must pay their shares of taxes to keep it going. In the case of Tim's Apple shop, that tax is equal to 40% of income, a fairly standard rate for any business. So 40% of the $2 million in profit that Tim Apple's business earned last year had to go to the government in the form of taxes. Since 40% of $2 million is $800,000, that left Tim's Apple shop with a net profit of $1.2 million. And this time we are done. Well, Tim has divided his business into 1 million equal shares. That means if the whole business earned $1,200,000, each share earned 1/millionth of that amount. Since $1,200,000 divided by 1 million is $1.20, each $12 share was entitled to $1.20 in earnings, right? Is that a good deal then? Let's look at it this way. If we invested $12 for a piece of Tim's business and it earns us $1.20 in the first year, our first year return on our investment would be $1.20 divided by $12, or 10%. A 10% return in our first year. Pretty good, right? Because we previously discussed that at the very least, we had to beat the 10% annual return from our investments in the S&P 500. That's because investing in the S&P 500 would earn us 10% a year without having to take any risk at all. Since we have the same 10% returns on the S&P 500 and for Tim stores, technically it is way better to use the S&P 500. Why? Because, as I said previously, we have to take any risk at all. But we will see why using a margin of safety is a big deal while investing in Tim stores. And let's use a good example, General Motors. Technically today it is selling for around $37 per share, and then you have three choices. First, you can buy shares in General Motors for $37 each. You can also sell your shares in General Motors and receive $37 each. Or you can do nothing, as you want. If you think GM is really worth $70 per share, then you might consider $37 a ridiculously low price and decide to buy some shares. Then, if you think GM is really worth only $30 or $35 per share and you happen to own some shares, you might decide to sell to Mr. Markets at $37. If you think each share of GM is worth between $40 and $45 per shares, you might decide to do nothing again. In short, you are never required to act. You alone can choose to act whenever you want and whenever the price is good for you. You can decide to sell your shares when the price is really high, or buy some shares when the price is really low, or again do nothing when the price is in between. And this is what's called the margin of safety. It is the difference between what you think the company is worth and the actual price. The goal here is to buy the company really low at a bargain again. In fact, the margin of safety exists to protect you from losing money in the stock markets. That's as simple as it sounds. And now it's time for me to ask you one question. All things being equal, if you could buy some share of Tim's Apple shops for $12, which of those earnings results would you prefer? First, would you prefer that Tim's Apple shops had earned $1.20 per share last year, $2.40 per share last year, or $3.60 per share last year? In other words, would you prefer that the earnings yield calculated using last year's earnings was 10%, 20%, or 30%? And if you answered 30%, then you are correct, because you would rather have a higher earnings yield than a lower one. You would rather the business earn more relative to the price you are paying for. Okay, let's take a break now. We've talked about lots of data, lots of information. It is now time to apply everything in real life. And we will simply need Google Finance. It's a free and wonderful tool packed with everything needed to invest in the stock markets. So, first number to watch is earnings yields. This number tells you how many dollars you can expect to make per year for each dollar you invest in a stock. You need last year's earnings per share, so how much money the company earned, divided by the total number of shares available. and the current stock price to figure it out. Dividing the two leaves you with a number in the format earnings per dollar, or simply your expected return in percent. For example, if last year the company earns $0.85 per share and now the stock price is $17, you divide 0.85 by 17, which leaves you with an earnings yield of 0.05. And that is an expected return of 5% for your money, or 5 cents for every dollar you invest. And no worries, I know that this calculation might take a while to process because it's sometimes hard even for me, but just watch again this video, or you can Google this calculation for you and you will find an answer or whatever you are looking for. Okay, the second number is return on capital, or ROC. This is calculated by dividing the net after-tax profit, so the final profit the company will keep after paying everything the company made last year, by the book value, so the number on their official balance sheets. This tells you how much of your investment the company turns into an actual profit. For example, if a $500,000 investment into a new steel production plant has yielded a $200,000 profit in its first year, that gives you a return on capital, or ROC, of 40%, which is really good in fact. Above 25% is solid, I would say. And finally, the PE ratio, or the price to earnings ratio. So why? And finally, the PE ratio, or the price to earnings ratio. Why is the PE ratio so important here? I think this is one of the most important analytics we could find on the internet to evaluate the real intrinsic value of a company. So the PE ratio gives you an idea of how much as an investor you will need to invest for every dollar in earnings. It basically tells investors how much a company is worth. Or in other words, this is a quick and easy evaluation metric to calculate and compare a stock and its peers. To conclude, after everything has been said, we already know that this method picks stocks that have both a high earnings yields and a high return on capital. For earnings yields, the formula looks for companies that earn a lot compared to the price we have to pay. For return on capital, the formula looks for companies that earn a lot compared to how much the company has to pay to buy the assets that created those earnings. And in one sentence, I can summarize this video. It's a question of how much cash it's gonna give you. That's it. While investing in a company, you wanna see how much cash it's gonna give you.